Hi everyone, good morning to all of you. Welcome to UN Digital class. Today we are going to discuss on a subject that is basic financial accounting. So on today's discussion we are going to present the accounting principles or the concept and convention relating to accounting. So listen carefully, we will discuss one by one. So before going to discuss what is accounting principle, first we must have to know what is GAAP. GAAP represents generally accepted accounting principles. So what do you mean by GAAP? GAAP may be defined as those rule of actions or conduct which are derived from experience and practice, and when they prove useful they become accepted principles of accounting. So generally GAAP represents generally accepted accounting principles. Principles represents the basic guidelines which are necessary at the time of preparing accounts or at the time of preparing financial statements. So during the time of preparation of a financial statement, either profit loss account or balance sheet, every organization they must have to be follow the code of conduct. Those code of conduct are based upon the GAAP, and these GAAP or these code of conduct are basically prepared by the accounting professionals, and these are followed time to time by every organization to provide a arithmetical accuracy or proof of documents relating to the organization at the time of presenting the report in front of a government or in front of a management or to the shareholders or everybody associated with the organization directly or indirectly. So what is the features of accounting principles? First one is relevance or usefulness, that satisfies the need of those who use it. So relevance basically satisfies, or at the time of preparing the accounting statement we must have to be go through certain principles, and that principle must be relevant and or that must have been useful. So when it must be relevant to the preparation of our accounting statements, it must have to satisfy the need of those who use it. That means the persons or the users, those are associated with the organization or those are associated with the accounting system by going through certain principle that satisfies them for getting the information correctly. And second one is able to provide useful information. So by following accounting principle, accounting report or statement is generated, and that report or statement provides basic or useful information to the users, those are associated with it. The second features relating to accounting principle, that is objectivity. So objectivity means that based upon facts and figures, we must take into consideration the facts or the figures or the transaction or events those are affect to the organization at the time of preparing the accounting statement. We must have to take into consideration that facts or the figures. So objectivity basically based upon the facts and figures those affect to the organization. The second one is no scope for personal bias. So nobody involved with the accounting system for making any type of a bias information, because the transactions those affect to the organization that must have been taken into consideration, and everybody or those accountants having responsibility maintaining the accounts, so they must have to take into consideration that transaction or events, and there is no personal bias of recording the transaction as per their wish. The third one is feasibility. Feasibility implies principles should be practicable. That means the principles or the rules or regulation or the methods that must have been taken into consideration and that must have been practicable at the time of preparing the financial statement. And the next is easy to use, otherwise their utility will be limited. So by following the principle we must have to present the information, or we must have to report the information in form of a statement to the others, so that it is very easy for everybody. Otherwise, if we will not go through the principles or if we will not go through the rules or code of conduct, in that case preparation of accounting statement is meaningless for everybody, and it does not provide a sense of accuracy, or it does not provide a sense of checking the reports in front of others. So now we will focus upon GAAP, that is generally accepted accounting principle. The very basic objective of accounting is to provide financial information to various interested groups for the purpose of decision making. We have already discussed in our first class that accounting is an art of recording the information or the monetary transaction that affect to the business in a systematic manner, and finally that present the information in the form of a report to the various interested groups. So basic objective of accounting is to provide the necessary information to the various interested groups associated with the business for the purpose of making a clear decision. Second one is, it is of utmost important that uniformity and consistency is maintained in preparing such financial statement. So by following accounting principle or by going through the GAAP, the accountant or the organization maintains the uniformity and there is a consistency system of maintaining the accounts or presenting the financial statement. Then the next one is, if business enterprise are left to have their own notion about the accounting terms like assets, liabilities, revenue, income or expenses, it will lead to confusion. That means if we will not follow the GAAP, if we will not follow the accounting principle or the code of conduct, in that case we may have to prepare the reports as per our opinion. In that case, that leads to making a confusion at the time of making a financial statement or presenting the report in front of others. We are having no sense of various accounting terms. So what is assets, what is income, what is revenue, what is expenses, like that, and that lead to create a very confusion for the accountant as well as for the organization, or those are associated with the organization who is called as the users. Accounting, being a man-made system, must evolve and adjust itself to change in the needs of mankind. So accounting system or accounting principle is prepared or followed by the man or human beings or the accounting professionals. So those are preparing the principles or those are implementing the concept and convention. As it is man-made system, it must have to be evolve or adjust with the changing scenario. That means whenever any changes occur, then the professional must have to change the principle or concept or modify that concept or abolish that concept and implement new concept or conventions. As a result, accounting principles are not exact and rigid as the laws of natural science. As it is man-made system, so we must have to change it. It is not based upon the natural science and which is cannot be changed. Because of man-made system of accounting, we can change whenever any changes arises. Therefore, emphasis is on general instead of universal. So it is not universal. It is based upon general concept and conventions and acceptability of various accounting principles. The GAAP are the building blocks of the accounting language. Rather, they are the pillars on which the structure of accounting is based. So basically, GAAP is the building block. It prepares everything relating to accounting statements. So that's why it is called as the pillar on which the structure of accounting is basically based. So this is accounting principle. Accounting principle is divided into two parts. One is concept, second one is convention. So we will discuss what is accounting concept and what are the various accounting concepts, then what is accounting conventions and what are the various accounting conventions. So first we will discuss what is concept and conventions. Concept meaning these are the assumptions on the basis of which financial statements are prepared. Concepts are the idea or thought which are universal application. So accounting concept means the basic assumptions or condition on which service of accounting is generally based. That means when we prepare the financial statement or we represent the report in form of a statement to the different users associated with the organization, we must have to take into consideration various concepts or principles. That concept is called as the accounting concept. That's why it is called as the basic assumptions or conditions on which the service of accounting is generally based. And that is the concept or the thoughts or the ideas which are having universal applications. Then the second one is conventions. Convention means these are derived by usage and practice. Convention need not have a universal application. That means accounting convention basically implies to the traditions or the customs which are applicable over several periods and that are prepared by the accounting professionals. As concept and conventions are prepared by the accounting professionals, so conventions do not have any universal application. It can be changed as the system will follow, or if any changes will arise, in that case the conventions or the customs and traditions can be changed. That's why it is called as having no universal applications. So there are various accounting concepts. We will discuss one by one. First one is business entity concept. Business is considered to be distinct from its owners or the proprietors, partners or the members. It is considered as a two distinct and separate entity. Transaction has to be recorded from point of view of a business and not owners. cash contributed by the proprietor, for example, add to the cash resource of the business and hence is debited to cash account, though it reduces the cash resource of the proprietor. The businessman is just like a creditor of the business. So business entity concept that signifies business and owner both are two separate entity and both are separate from each other. Business is treated as one separate legal identity and existence, and it is purely separated from its owner. What the amount of expenditure or income that affect to the business should be taken into consideration business books of account, or that is meant to be recorded in business books of account. If any personal transaction affect to the business, then in that case that must be recorded. Otherwise, owner personal transaction is meant to be recorded in owner personal account and business transaction is meant to be recorded in business books of account, as both are separate and distinct from each other. The second one is money measurement concept. As per this concept, only monetary transactions are recorded in the books of accounts. Measurement of a business transaction in money helps in understanding the state of affairs of the business in a better way. Accounting does not give the picture of non-monetary items. It is due to this concept recording in terms of money and recording only monetary items. So money measurement concept, that means business is meant to record only those transactions that affects and that is only in monetary terms. We have to take into consideration only monetary transaction or events that affect to the business. Non-monetary transactions should not be taken into consideration or should not be recorded, as it affect to the business, but we cannot record it because it is not measured in terms of money. Suppose employer of the organization dies due to some disease or any other things, or there may be a strike or a lockdown in the organization, but that cannot be recorded in business books of accounts, though it affect to the business, but as it cannot taken into consideration or measured in terms of money, so we cannot record that transaction. That is a non-monetary transaction. So business is meant for recording transactions in monetary forms and only monetary transactions should be taken into consideration. Then the third one is going concern concept. It is the basic idea that a business will continue for a long time while recording and reporting the transactions. It is due to concept that proper distinction is made between capital and revenue expenditure. Assets are classified into current asset and fixed assets. Liabilities are also classified into short-term and long-term liabilities. Use its fixed asset till the end of their useful life. So going concern concept, that means business is a going concern nature. It will not never ending process. The members may come into the organization, the members may leave the organization. So, but business means business. Business, it will continue forever. But the transaction that affect to the business should be recorded in a systematic manner. That means we can record various assets and that assets are classified as fixed asset, current asset, fictitious assets. We must take into consideration the liabilities and that liabilities also classified into various categories: short-term liabilities, long-term liabilities, fixed liabilities. So everything should be recorded in a systematic manner or in a proper way, but that will continue forever. Whenever any transaction affect to the business, that will be considered and that will be recorded, as business is a going concern nature. Then the next concept, that is accounting period concept, that divides entire indefinite life of the business into smaller periods. 12 months is considered as one accounting period. Reports the result of the activity undertaken in a specific period. So accounting period concept, that means the period is taken into consideration. Generally at the time of preparing the accounting statement or preparing the financial statement, we must take into consideration 1 year. Generally 1 year is taken as 12 months. So whenever any transaction affects during that prescribed period, we must have to record the transaction at the time of preparing the financial statements. So that year may be a calendar year or may be a financial year. Generally calendar year represents from 1st January to 31st December, or a financial year that represents 1st April to 31st March. Then the next one is cost concept. Asset is ordinarily recorded in the books at the price at which it was acquired, that is called as the cost price. Though recorded in the books at a cost, in the course of time they become reduced the value of accounts of a depreciation charge. It is known as historical cost concept. Assets do not reflect the real worth, that is the price level changes. So cost means the measurement of all expenditure. Actually when a asset price is recorded or anything is recorded, the total cost is taken into consideration at the time of recording in the financial statement or recording in the books of accounts. That means how much expenditure is incurred for producing a product or providing a service. The total cost incurred for producing that product or providing that service we must take into consideration, and that must have been recorded, and that cost is called as the historical cost. Then the next concept, that is dual aspect concept. So for every debit there is a credit, two-sided effect to the extent of same account. This concept has resulted in an accounting equation, that is asset minus liability is equal to proprietor's fund or proprietor's claim, that is known as capital. So dual means two. Every business transaction having two-fold effect or two aspect. That means for every transaction there must be debit that represents to corresponding credit. For every debit there is corresponding credit, and a equal amount of debit equal to equal amount of a credit. So if we will present in the form of accounting equation, that we can know that asset minus liabilities is equal to capital. Then revenue recognition concept. Profit should be considered only when it is realized. No anticipated profit should be taken credit of. So revenue recognition concept that implies when any amount is realized, we have to taken into consideration and must have been recorded in the books of account. Unless and until that is not realized, we have to use it in the business during the course of transaction. That cannot be taken into consideration, whatever may be the market price. We have to forget it and we have to record it the amount at which it was taken or during the time of a profit. Then the next one is matching concept. Expenses should be matched to the revenue of the appropriate accounting period. For example, salary paid in January 2011 relating to December 2010 should be treated as expenditure for 10, not for 2011. So matching concept means we must have to take into matching the revenue with expenses. So the exact amount of revenue with expenses should be matched to find out the actual profit. There is one example mentioned in the slide. That means when one type of expenditure, that means salary relating to 2010, that is paid in 2011. So when it is paid, that should be taken into consideration. As it is paid in 2011, so we must have to record it in 2011, not in 2010. Then accrual concept. Accrual is concerned with expected future cash receipt and cash payment. Make record of all expenses and incomes relating to accounting period, whether actual cash has been disbursed or received or not. For example, purchase and sale of goods on credit, rent not yet paid, salary outstanding. So accrual means revenue, whether it is earned or not, expenses, whether it is paid or not. So if that affect to the business, we must have to be consider it and we must have to be record it. Whatever may be, that is paid or not, received or not. So any type of a transaction that related to revenue or that related to expenses, whether that is paid or not, received or not, as it affects to the particular period, we must have to be consider that and we must have to record during that period. Then the next is stable monetary unit concept. That means purchasing power of a monetary unit remains same throughout. That means whatever amount of purchases has been made during the course of a transaction, that remains same, and that same amount must be recorded or considered at the time of preparing financial statements. So the next part relating to accounting convention. We know that convention that refers to customs or traditions that is followed or maintained by the books of accounts at the time of preparing the financial statements. So basically there are various accounting conventions. We will discuss one by one. The first one is convention of a disclosure. So that represents financial statements should disclose all material information clearly to the reader. State the fact of a change in accounting policy and methods, if any. So disclosure means we have to disclose or inform everything if that happens or that affect to the business. Whatever may be the transaction that related to income or expenses, if that affect to the business, we must have to disclose it, we must have to represent it in the form of a report or in the form of information to the accountant at the time of preparing the financial statement. Then the next one is convention of a consistency. Same accounting principle for preparing financial statement for different periods. Policy once adopted must not be changed, only be changed by showing the fact in the annual report, for example, depreciation. So convention of a consistency. Consistency represents constant. That means once the organization or accounting system will follow the methods or procedures that must have been followed or repeated over several years. Unless and until specific changes arises, we cannot change that method or we cannot modify that methods. Once we change it, then in that case that lead to confusion. We cannot make a meaningful comparison over several periods. For example, depreciation. There is one method of a treatment of a depreciation, or there are various methods of a treatment of a depreciation. There may be straight line method, there may be diminishing method, some of the digit method, insurance policy method, but whenever we follow any particular method of a depreciation, we must have to follow over a several periods so that we can make a meaningful comparison over that periods. Then convention of a conservatism. Cautious approach or policy of a play safe, be pessimistic. All losses must be provided, but profit should not be anticipated. Possibility of a loss taken into account at the earliest. Prospect of a profit ignored until it does not materialize. So conservatism, business always follow conservatism principle. That means anticipate no profit but take all precautions for possible future losses. Whenever any profit is not materialized, in that case organization should not be considered or should not be taken into consideration. But organization must have to take proper precaution or prepare proper steps at the time of any loss or any negative situation arises. So the organization must have to take all precaution for possible future losses but should not anticipate any profit unless and until that profit is materialized. Then the last one is convention of a materiality. That means it only significant transactions are recorded. Insignificant transaction should find no place in the books of accounts. So there are various types of transactions that having significant effect. If that transaction having significant effect, we must have to record it in a separate account. But there are various transactions having small importance or very small amount of expenditure is made relating to that head. So in that case, that is having no significant effect. So we must have to record it under one head, that is called as a miscellaneous expenditure or miscellaneous receipt. For example, postage, telegram, telephone bill or snacks, anything else. So that is very significant or very small amount of expenditure is made during that head, and we must have to take it under one head, that is called as a miscellaneous. Then after that, accounting equation. In every business transaction, one aspect represents asset or expenses and other represents claim or income, and these two aspects are always equal. So this approach generates the concept of accounting equation, which is summarized as liabilities is equal to asset or external liabilities plus capital is equal to asset. We already completed as per the dual aspect concept. For every transaction that is having two aspect or twofold effect. For every debit there is a corresponding credit. So the total of a debit must equal to the total of a credit. If we have to take into consideration that the amount of expenses and income and these two aspects are always equal, we must have to be conclude that. And this approach generates a form of accounting equation which can be known that asset minus liability is equal to capital or proprietor's fund. So there is a procedure for developing accounting equation. That the first one is step 1, ascertain the variables. That means whether it is assets or liabilities or capital that must have been identified or that must have been ascertained. The second step, find out the effect of the transaction. If that is a case of transaction and that affect to the business, we must have to find the various effect. Whether out of that transaction which is the assets, which is the liability or which is the capital, and accordingly we have to be record it under the different heads. Then step 3, show the effect but ensure that the total of right hand side is equal to the left hand side. After identifying the assets, liabilities or capital, we must have to be represent in the form of equation, and in form of equation we must have to show that the total of left hand side must equal to the total of right hand side. That means asset minus liability must equal to capital. That is at every cases we must have to be show that. That is known as accounting equation. So this is our today's discussion regarding to accounting principle, which states various accounting concept and convention and accounting equation as per the dual aspect concept. In our next class, we will work out various problems relating to accounting equation, and we must have to show the transactions relating to assets and liabilities and capital and what are the effects. And in every cases, we must have to show that the total of left hand side must equal to the total of right hand side. So till then, bye bye, have a good day.